Barloworld has just released its results for the 6 months ended 31st of March 2016, and these are some of the financial highlights. Firstly, our revenue was up 4% to around 32 billion rand, and that drove an increase in operating profits of 1% to just under 1.8 billion rand. Our profit before exceptional items was up 6%, while our basic earnings per share was up 4%, and our headline earnings per share was down 9%, mainly as a result of weakness in the associate income out of the business in the DRC. Pleasingly, we saw cash generated from operations of 1.2 billion rand in the period, and that was a strong turnaround from the 2.2 billion cash utilised in the prior financial period. And that was really driven by a strong focus on inventory reductions and receivable reductions, principally in our Equipment Southern Africa business. Our board declared an interim dividend of 115 cents a share, which is in line with the declaration last financial period. Moving on to some of the divisional results, and I think Equipment Southern Africa continued to face a very difficult overall mining environment, and that led to weakness in top-line revenue growth and a 15% decline in operating profits. Notwithstanding that, we saw some growth in construction activity in the 6 months, and our aftermarket held up relatively well, despite the fact that certain customers have been delaying equipment maintenance. One of the highlights of our 6-month results was trading in our Equipment Russia business. There we saw very strong top-line growth in dollar terms and also very strong growth in operating profitability. And that was on the back of some strong mining equipment deliveries into particularly the gold and base metal sector, despite the fact that the coal sector remains depressed. Also pleasing was our Equipment Iberian result, which showed a further year-on-year improvement in profitability as a result of some top-line growth in new equipment, power and aftermarket sales, despite the fact that international used equipment sales were lower. Moving on to our automotive division, there we had a satisfactory performance with a good result coming out of our car rental business, driven by our dual brand strategy with Avis and Budget, which is succeeding very well in terms of market share growth. The motor trading business came under some pressure because new car sales are declining in South Africa, but this was somewhat mitigated by growth in our aftermarket business. On the Avis fleet side, we saw a small decline in profitability on the back of the non-renewal of the government of Lesotho fleet contract, and also lower used equipment rollouts as certain customers delay their fleet replacement cycles. Our logistics business showed year-on-year improvement in profitability, and this was on the back largely of organic growth in the Southern African business and the disposal of certain of our loss-making international operations. Overall, I think the group is facing some challenging trading conditions, particularly in the mining sector, but our business overall displayed continuing resilience as a function of diversity in our operations, both geographically and also in terms of the industries we serve. Going forward in the second 6 months, we will continue our strong focus on cash generation through managing our working capital downwards, and I believe that we're well placed as a business to capitalize on growth opportunities as the cycle turns.